The U.S. Federal Reserve on Wednesday raised its benchmark interest rate by 75 basis points, the second hike in a row of that size, as elevated inflation showed no clear sign of easing. Headline CPI has remained over 8% since March this year. CPI in June surged 9.1% from a year ago, hitting a fresh four-decade high. This is a stark reminder that the Fed has a long way to go to bring elevated inflation under control. Fed Chair Jerome Powell said at a press conference that another unusually large rate hike could be appropriate at the next meeting in September. According to a CNBC survey, 63% believe the Fed's effort to bring down inflation to its 2% target would create a recession. The Fed has already hiked interest rates by 225 basis points since March this year and is set to continue its aggressive path. Given its important role in the global financial system, there are spillover effects. The International Monetary Fund said Tuesday that tighter global financial conditions could induce a surge in debt distress in emerging markets and developing economies.
Will there be negative effects in the global economy by these rising interest rates? Absolutely, of course. This is one of those difficult circumstances where the centrality of the dollar really imposes upon other policymakers, other economies, many difficult choices. We're moving from a situation of quantitative easing and fiscal stimulus where there's more slack, more opportunities for actors to sort of figure out how they want to use the extra flexibility they're given, to a situation where hard choices are going to be imposed on various market actors. The question is whether there could be a global recession triggered by the US approach to inflation. And the answer to that is absolutely there could be. And it is quite conceivable, more than just could. I think that depending on the Federal Reserve's approach, it might even be likely. It all depends on just how aggressively the Fed raises interest rates.